Just go ahead and type the word more so I know. Now that you have commented, let's continue. Performance plus efficiency equals a sticky value proposition. Combine scalable, high-density infrastructure with energy savings and you get a product that appeals to hyperscalers, cloud providers, and enterprises simultaneously. That dual appeal, performance for compute capacity and efficiency for cost/environmental reasons, is why SMC has become a recognizable name in AI infrastructure circles. For investors who like bets on structural secular demand, AI compute growth, that's a meaningful selling point that could symbolically 70x Smci. Challenges, the reality check. Regulatory and governance headaches. Being a global hardware supplier means playing by many rules, tariffs, export controls, country-specific certifications, and financial reporting standards. SMC stumbled here previously. The company highlighted weaknesses in internal financial controls, leading to audit and filing headaches that spooked investors and briefly jeopardized its listing status. Those governance issues aren't a mere PR bruise, they can slow institutional capital inflows and raise borrowing costs. Trust, once dented, takes time to rebuild. Imagine your favorite cafe had a health inspection scare. Even after they fix the kitchen, some patrons won't come back until they're sure the eggs are safe. Supply chain dependencies, the sinew and the sore spot. High-density servers depend on GPUs, specialized PCBs, custom racks, and cooling systems, all of which must arrive on schedule. A global component hiccup or a sudden spike in GPU demand can delay deliveries and shrink margins. SMC's business is lumpy. A single large design win can swing a quarter dramatically if it is deferred. That's profitable when deliveries are on time, but painful when the calendar shifts. Running SMC's order book is like a wedding planner for giant machine weddings. Move one venue date and 3 bands, and a quarter's revenue can vanish into the ether. Competition from the giants. HPE, Dell, Lenovo, Inspur, and others are racing to ship AI-optimized platforms and have advantages in global sales, financing, and integrated services. These incumbents can undercut on price for massive deals, bundle software and services, and offer global procurement scale that's tough for a smaller OEM to match. SMC's niche is speed and specialization, but scale often wins in multi-region, managed service contracts. AB Research and other market trackers show SMC is a meaningful player in AI servers but not the largest, which matters for very big customers who prefer vendor redundancy and global support. The October downtrend, what happened and why it matters. Timeline and key move. In late October, October 23rd to 24th, SMC disclosed a trimmed revenue outlook for fiscal Q1 2026. The company revised its prior $6 to $7 billion range down to roughly $5 billion, citing customer requests to push out large AI server deliveries while designs were upgraded. That announcement initiated a fresh wave of investor concern, not only because of the miss itself but because the market's memory includes those earlier governance and filing issues. Reuters and other outlets covered the update. The cut was framed as a timing issue caused by design win upgrades, rather than a sudden collapse in AI demand. The design upgrade explanation, temporary or terrifying? Management said many delayed sales were due to a customer requesting upgrades to GPU rack configurations, essentially engineering changes requiring rework and delaying deliveries into the following quarter. That's important. A timing delay, projects moved to Q2, is materially different from cancellations or demand erosion. If customers simply push delivery weeks or months to get a better configuration, revenue may appear later and margins might recover. If customers cancel or defect to another vendor, the damage is structural. The market's job is to price that probability. Reuters noted SMC still affirmed strong underlying demand and reaffirmed longer-term revenue targets even as it revised quarter guidance. It's like a contractor saying, "We will still build your mansion, but the client wants marble instead of granite," so the project's timeline shifted. The work still exists, the calendar moved. The aftermath, stock reaction and messaging. When SMC trimmed Q1 guidance, the stock reacted with a swift drop. Investors hate uncertainty, especially after a run-up in price. Headlines highlighted the miss and reminded the market about past accounting control problems that had once flagged delisting risk. But SMC's message was, demand is intact, deliverables are being upgraded, full-year expectations remain ambitious. Whether investors believe that depends on whether they see the delays as transitory engineering noise or a sign of execution trouble. Why the reaffirmation of annual revenue matters, and why to be skeptical. Reuters reported that while SMC cut its Q1 forecast, it still reaffirmed a full-year revenue target of at least $33 billion, a signal that management expects the missed sales to shift rather than disappear. That kind of reaffirmation is the company saying, "We still see the market, the timing just moved." That matters because it tells investors SMC isn't seeing a collapse in orders, at least, that's the management story. But investors also remember the company's recent reporting and auditor worries, which tempers trust and can delay the multiple re-rating until execution and reporting prove clean. Note this as well. Do you want peace at heart? The next day John seeth Jesus coming unto him, and saith, Behold the Lamb of God, which taketh away the sin of the world. John 1:29. Fear God, and give glory to him, for the hour of his judgment is come, and worship him that made heaven, and earth, and the sea, and the fountains of waters. Revelation 14 verse 7. I appeal to you to fear God and obey his law. For his commandments are sure and his word everlasting. Do not be afraid, do not be discouraged. Want more information? Please check the description section. That's the end for now. If you have watched until the end, drop a comment like this, I stayed until the end. Just comment that I stayed until the end. When I see this comment, I will give you a heart. 3 more favors I request from you. First, like this video, subscribe and then turn on the notifications bell. If you do this, you greatly encourage me to continue bringing to you insightful information. Do not miss out on our future videos full of insight. All I am asking is your subscription. Thanks for joining us today, your support means so much to us. Do not hesitate to share this video to help someone who may benefit. I recommend that you watch the next video, subscribe to the channel and share your thoughts about today's video. Wish you God's blessings and care. Wait, watch and pray. See you in the next video according to God's will. Imagine a race car built in a garage by a genius mechanic. It's lean, tuned for speed, and wins weird hill climb races where the big factory teams fumble. That super microcomputer, SMC, a smaller server OEM that built razor-sharp, energy-smart machines for the AI boom. Then one quarter a giant customer asks to upgrade their pizza oven-sized GPU racks, a delivery slips, and suddenly the shop window looks empty. Cue the panic. But underneath the drama, scalable designs, liquid cooling chops, and a sustainability story that investors, and the planet, like. SMC builds high-performance server and storage systems, the kind of hardware that sits at the heart of AI clusters, crunches model training, and hosts inferencing at hyperscaler scale. Their pitch, dense, power-efficient systems that let customers pack more GPU horsepower into less rack space and pay lower power bills. That combination, performance and efficiency, is a seductive formula for AI data centers trying to squeeze more throughput out of limited power and floor space. Strengths: why SMC turns heads. Scalable infrastructure solutions, built for AI workloads. SMC's architectural DNA is about density and configurability. They ship racks and servers designed to handle high GPU counts, specialized cooling, and rapid integration with partners' technology stacks. For customers that need bespoke solutions, think unique rack configurations, liquid cooling, or higher-density GPU layouts. SMC is often faster and more flexible than larger, slower incumbents. That makes them a go-to for cutting-edge AI deployments where one-offs and rapid iteration matter. If Dell and HPE sell all-you-can-eat buffet servers, SMC sells a la carte tasting menus tailored for chefs who want a Michelin-quality AI dish, but only in select restaurants. Commitment to green computing, energy efficiency as a selling point. SMC has emphasized energy-efficient, liquid-cooled designs, which isn't just marketing fluff. Liquid cooling allows much higher GPU density per rack and significantly reduces the energy waste of traditional air cooling at scale. For customers worried about power caps, data center TCO, or sustainability mandates, these efficiency gains are real dollars saved and a smaller carbon footprint. That environmental angle attracts both tech-forward and ESG-sensitive buyers. Imagine squeezing twice the computing into the same electrical bill, like upgrading from a gas guzzler to a hybrid without losing speed. Positive, historically robust, financial performance, a cushion for investors. Before recent hiccups, SMC rode the AI tailwind with rapid revenue growth and strong demand cycles, especially during GPU supply booms. That historical performance gives investors some faith that the business model, specialized, high-margin systems for AI, can be highly profitable when orders land on schedule. In short, the company has shown it can convert specialized engineering into cash when the market cooperates. By the way, if you are benefiting from the content so far and want more like this, like the video, it means much to me, or hit the subscribe button and comment the word more.